Welcome back. Today I just want to go over several of my favourite REITs, that is real estate investment trusts. So this is one really wonderful way to invest in real estate without all of the problems and issues and challenges that you actually would have with managing real rentals. It also gives you the opportunity to diversify over different types of real estate in a way that most people don't have when they're just sort of investing in real estate rentals in their nearby neighbourhoods. So today we're going to look at several REITs. They're going to be a diverse bunch here, looking both at capital appreciation in the long term, which is pretty sweet, but also looking for some pretty good current income. So stay with me as we look at some good REITs for 2023 and beyond. Okay, Essential Properties Realty Trust, EPRT. So this is one of my favourite plays that I think is going to deliver both reasonable income now as well as some pretty sweet long-term capital appreciation, and of course wanting to buy this at the right type of valuation. Now, if we look at the history here, obviously it is a fairly new REIT, but I do see it as somewhat akin to Store Capital, sort of Store Capital version 2. I'm hoping it will grow consistently like Store Capital did. It follows a similar type of philosophy in terms of identifying those sort of essential properties which aren't going to be so badly affected by other situations, external situations. And a huge amount of diversification there as well over this type of property. So they're not looking to be properties that are going to be disrupted by, for example, more internet shopping and things, but you know, places, locations that people are still going to return to time and time again physically. So continuingly needing this real estate. Now, what does this mean for the company itself? Well, it means that at the moment we've got a dividend yield of about 4.8, so pushing 5%. Now, if we look at these estimates here for future AFFO, adjusted funds from operations, kind of like the a good measure of earnings for the real estate. We can sort of see here that we're expecting in 2023 a 6% increase in AFFO, followed by a 2024 increase of about 6% here in AFFO. Now, that's on the back of some fairly strong increases in 2021 and 2022, so not disappointing really. 6% is fairly steady growth. Throw some the sweet dividend yield on top of that, and long-term appreciation and value gain to you as an investor could be reasonable. And what is this company likely to do? Well, switching over to the Fast Graphs forecasting calculator. I'm not sure it's going to be deserving of a 20 times price to AFFO calculation. I think 18 times is a reasonable recognition of the value and the quality of this company, the management team here, and the care and consideration and safety with which they conduct their business. So using about sort of an 18 times price to AFFO estimate, if prices do return to this ratio and the analyst expectations for the AFFO in 2024 are met, we may be talking about a 45% total rate of return till the end of 2024, or a 20% annualized rate of return. Now, how likely is this to happen? Well, obviously, we don't know what's going to happen with prices over this time. But one thing that we can see is that these analyst estimates for AFFO have fairly steady in 2023 and 2024. Slight revision upwards there in 2024, but otherwise reasonably consistent. Not too many big changes here. As we can sort of see for 2023, 2022, they were quite consistent for 6 months as well. So fairly stable, fairly good. Few swings and few changes there, and I like that type of consistency. I like a company that can be well forecasted, that can be well understood, kind of like EPRT. So I think some really good opportunities here, a company that I think we can hold for the long term, that's got some really good AFFO gains in the future here. It's a relatively small REIT as well, so I think lots of opportunity to grow, and of course the prices should begin to increase along with these AFFO, and of course the dividend yield if you buy now is reasonable as well. So Essential Properties Realty Trust, have a good look at it, do some deep dives into the property portfolio that they have, and get a sense there of the quality, and if this is something that will fit you and your investments and your portfolio. So if you like this, if you think this is helpful, hit the subscribe button, ask a question down below, tell me if you're already invested in EPRT, and if not, I'm keen to hear your thoughts about why not. Okay, next up on the list we have at Simon Property Group, or SPG. Now this is quite different to EPRT. SPG focuses on very high value, very good quality malls and retail opportunities. So we're not talking about dodgy, cheap, nasty shopping centres, but instead, you know, class, high value and affluent neighbourhoods. So there's sort of a recession-proof experience based element here to the type of malls that they do invest in. Now obviously when you see the pandemic, we can see the huge decline there in value of the REIT stocks, so that would have been substantial, and to be frank, you can't really avoid that with a sort of an in-person transaction-based retail type REIT like SPG. But if you look at the history though, they've got this sort of long-term AFFO growth, sort of earnings growth here that has been pretty good until the pandemic. It's sort of recovered quite strongly. Now the analyst estimates for 2023, 2024 are sort of 4 to 3% gains per year. And on top of that, we've got a beautiful, juicy 6% dividend yield even at the current prices. Now, what does this mean? Well, it means if prices return to sort of the normal 5-year price to AFFO multiple of about 15 times, which I think is reasonable given the quality of the company. Its S&P credit rating is A-. It's a reasonable size, $37 billion market cap company. And if prices return to this 15 times price to AFFO ratio, so prices rise and the analyst estimates for AFFO are on the money, by the end of the 2024 year, we should be talking about a total rate of return of about 65%, or a total annualized rate of return of about 28%. Now, again, is this likely to recur? It's hard to tell. But if we look here at the analyst estimates, they are, again, like we saw with EPRT, relatively stable. A little bit of a decline here in the 2024 expectations, but not a substantial decline by any measure. So again, I think this has some opportunity here for both reasonable dividend yields in the present, as well as quite reasonable capital appreciation as prices begin to climb. Now, how accurate are the analysts? I didn't show the analyst scorecard on Fastgraphs for EPRT because of the short history. Here though, with Simon Property Group, they've been around, and we can sort of see here for 1 year estimates forward with a 10% margin for error. The company beats those analyst estimates about 25% of the time and hit them 2/3 of the time. So most of the time they're bang on the money, the exception being in 2020. Now if you look for analyst estimates for AFFO 2 years out, again 2020 was again the aberration, but again they hit those expectations with 20% margin of error. 4 out of 5 times they beat it a little bit, and so I think this is fairly consistent and fairly safe. And of course, if you think about what happened, wow, I mean, who could have predicted that pandemic? And yes, of course, in terms of sort of the shopping centre focus, SPG got thumped badly. Can't avoid that. It's just one of the risks of investing. But I think here some really nice future growth. And you can sort of see in the 2013, 2016 years as well, the prices were much higher than the AFFO. So we're talking about a price to AFFO ratio of 25 times, which I think is a little bit extreme. I personally wouldn't have been buying in the 20s for that ratio. So again, we could see some very strong upswings in prices based on past historic valuations. Now, last and not least is Arbor Realty Trust. So this is a mortgage REIT. It's a relatively small company, substantially smaller, say, than SPG. And they're really focused on sort of an annuity-based business model. So One of the things that they do focus on is quite a good spread of the loan portfolio. So most of it is sort of a bridge loan, sort of 98%, I believe, instead of a multifamily asset class. Geographic locations are focused quite heavily in Texas, Florida, Georgia, for example. So that's I think about a third of the portfolio. So there is some portfolio concentration there. So markets that they know very well also. So they focus. They're very, very clear about what they do and how they do it. So one of the good questions here is what happens to Arbor Realty Trust being a sort of a residentially focused REIT during a recession, particularly with mortgage REITs. They tend to be more volatile. And the answer is I can't tell you that. However, I do know, looking through the earnings calls, that the CEO and the management team are very, very focused on disciplined approaches, very conservative assessment of the borrower quality, and I think they've been ratcheting up the focus on borrower quality over the last couple of years as well. So it sort of looks like they've been preparing for and battening down the hatches a little bit here, as well as they begin to assess their own portfolios for the loans. Now, going back over the earnings calls as well, sort of 3 quarters ago, or several quarters ago, they were sort of talking about how they were sort of backing off on the loan originations. They felt that it was going to sort of tip over, and we can sort of see that, I think, as well as we're looking at the market now. I think they were ahead of the curve there. They were being very conservative. Rather than going out and chasing market share, they sort of pulled back and they shored up their own business in a very, very sensible and safe way. So sort of, again, battening down the hatches and preparing for the worst case scenario. So Arbor Realty Trust does have a sort of an expected decline in earnings actually over 2023, 2024. Again, that could be recession based, and we could see some potential upside or upswings on the earnings if and when the economy sort of recovers and sort of springs up again. Now, what does this mean? It means that we might expect prices to sort of increase. If we take the normalized price to earnings multiple of just under 9 times, we expect prices to return to that level at the end of the 2024 to that multiple. We'll get a small price gain. We'll also get quite nice dividend yield as well, with sort of a total rate of return of about 17% or an 8% annualized rate of return. Now that is going to be mostly driven by the dividend yield being relatively juicy and sweet, and some price appreciation, but it's really predicated on whether or not the earnings decrease or slump as we've seen. Now, the other point to note as well is that Arbor Realty Trust has had some very strong dividend increases. So $1.38, $1.55. Now, the increases are expected to slow down a little bit in the coming years. They've been quite strong, about 15% per year gains in the last several years. I expect they'll slow down quite a bit with the squeeze on their earnings. So there's just simply not going to be quite as much money there to distribute to the shareholders. Consistency of the analyst expectations at a $1.93, $1.83, $1.82. So some consistency there. It's a little bit weaker than we saw with the EPRT and SPG, which is sort of what I expect with a mortgage REIT. Now, the prices also fluctuate quite a bit as well. So here we saw, prices at about $18, $20, down to as low as $11.50. So very much with ABR, buying this at the right time is going to be absolutely necessary. Now, do analysts do a good job of predicting and estimating what those earnings are going to be? Well, if you're looking 2 years ahead with a 20% margin of error, heck yes. And in fact, most of the time the company beats the analyst expectations. And again, even over a 1 year, most of the time the analysts the company beats the analyst expectations. So I think we've got some good opportunities here, even with these relatively I think conservative forecasts here. Again, if the company is going to beat these analyst expectations, I think we could see some really nice potential upward swings here. So look, everyone, that is 3 real estate investment trusts, 2 with physical properties, EPRT, and SPG, and Arbor Realty, ABR, a mortgage REIT, which is going to give us higher dividend yields and income, some growth in the income, but is going to be more volatile and potentially higher risk heading into a potential recession ahead of us. So everyone, I hope this is helpful. If it was helpful, leave me a comment down below and let me know which of the 3 real estate investment trusts here today you are invested in, which ones you like the most, and which, if any, you might avoid. I have positions, long positions in all 3 of these companies, to varying sizes. So I do like each 3 of them for various reasons. So look, everyone, I'll catch up with you again soon. Thank you very much, and stick around with me.